Good morning, everyone. This is Bagadon, StockMarketCaddy.com. It's March 2nd at 9:45 a.m. And we wanted to give a glimpse, just a glimpse of what our subscribers get each and every night. Their full review is anywhere from 30 minutes to 1 hour. Usually on a Sunday evening, it is 1 hour. They'll get not only a view of the markets, but also individual stock opportunities, and for those folks that are trading futures as well. Let's take a look at our proprietary indicators called what we call the stock market caddy, the pro shop. This is where we park all of our indicators. I'm going to take a look at all of these markets. Let me just remind everyone that we trade for a living, and I want to bring into view our trade manager. These systems are written from our own experiences in trading the markets. This is our full trade manager. We trade weekly, monthly, 60-minute, 240, 60, 240 daily, weekly, and monthly time frames. Smaller time frames we consider almost bird food, and we use those time frames to hedge our longer positions. But this is what our trade manager looks like live, real time. We don't have a position in every position. But we take many of these. They're not all winners, as you're going to see. We also have losing positions. What's good about a systematic mechanical trading system is that the losers are generally small. The machine, we follow our own tools, eat our own cooking, and if the machine is quick, it's programmed quick to get out of losing positions, and we follow it. But let's come back to the full view. Excuse me. We're going to hold off for the moment. Let's just look at the markets and hold off with the noise of the day, being Putin and Russia and all of that. We're aware of that. But let's first look at what the market is showing us. We want to look at the volatility index. To drive home further, this is where people buy insurance to insure their winnings, their portfolio. So it's a contrarian indicator. If they're very confident in all of the events of the world and in the markets and the economies, they generally won't buy any protection, and the volatility index will be in a short mode, meaning they're buying mostly calls, or they're not buying any put insurance, and they're bullish when they're like that. When they're buying put insurance, when they have some concern, they'll spend 1, 2, 3% to try to insure and protect some of those profits. The volatility index will go into a long position, and that generally coincides with a defensive or maybe a more bearish market. When I say bearish, I'm not talking about a full-blown 20%. I'm just talking, a defensive market. Let's start with that first. Remember, any bearish market must start with a pullback, then a correction, then a bear. So, we're gonna, we got to do our best to monitor pullbacks here in a market that has obviously been bullish now for some time. The volatility index, we did see a spike in volatility on Friday afternoon on the 1 hour and the 240. You can see it went long here, so that would have been defensive for the market, reversal up. We're also getting a signal. This CTL is a signal on the monthly time frame that we could be seeing a turnaround, in that it would go from short to flat. Our system, this is our strategy here. Our system cannot, it's either long, short, or flat, and it will go, flat is just in between. It'll go from flat from here. It'll either go reverse back down short or go long. If it goes long in these time frames, that would coincide with the market being defensive. And I should point out we have 60, 240 daily, weekly, monthly. The larger time frames, of course, trump, but you need to know where you are. If you're not in a weekly or monthly time frame and haven't been in this market for the last 3, 4, 5 years, you don't want to be just waltzing in, oh, it's monthly and I'm going to get long, whatever it is. What we had been commenting on much of the last 10 days is that the markets had resumed their march long, but the volatility index was not. It should have been confirming with a short signal on all these time frames, and it wasn't, which told us that there was some underlying concern in the market and that some players were continuing to buy puts, and they weren't adding to their winning positions. So we got to start with that. If they stop adding to their winning positions, well, then maybe we do pull back. Here's the S&P on a 60-minute time frame. You can see that we went flat. That was on Friday afternoon. The S&P dropped 20 handles in the space of about 10 minutes, 10, 15 minutes. And that's the sort of thing that can happen. And that was, looking back, Obama's press conference, the headline on Drudge possibly. But the market, responded in to the headline. We're seeing, though, here on the major time frames, daily, weekly, monthly, and we've been commenting on this now for the last several days, last couple of weeks. We're seeing this collection of what we call high divergence on these very key markets, on these very key time frames. And what that means is that, yes, the market is coming back up to its old highs, but we're getting divergence. This is a basket of indicators that proprietary that we've written that is saying that they are not confirming the high, meaning that the last time the markets were at the high, this basket of indicators were also reaching new highs, and they are not. So it doesn't it's not it gives us pause. It tells us it's not a short signal, but it's telling us that potentially this high may not be sustained. And that was before Friday. That was before the headline. The market will tell us what we need to know before any of the headline. And so here's the view of the NASDAQ, and here is, you can slow this video down, same thing with the Dow. And here's also a high divergence on the daily. So the market's been strong in showing the potential for at least a pullback. Dollar weak. Japanese yen, this is interesting. Don't want to get all into the Japanese yen carry trade, but basically what folks have done, this is not individuals, this is a big hedge funds. They borrow short the yen and put that money to work in risky assets. Well, the yen, that's all great when the yen is in a short mode, but you can see here that on a daily the yen is actually in a long mode. So if the yen should begin to rally, that could put pressure on the carry trade. And what they do is they begin to unwind it. And the first thing they need to do is sell some of the riskier assets and then make the trade on the yen. Does you no good if you're in a risky asset and the yen should rally. You'd lose your profits on the conversion. But so this also gives us a hint, and this CTL is a hint that the yen could be going long. Fundamentally, you wouldn't be expecting that, but that's what the market is telling us. And so that would be also a hint that the market could be setting up for a pullback. This is the euro, very strong euro. Translation being that the European markets are getting very defensive, long before the headline of Putin. And what's come down, same thing with the British pound. And then the 10-year bond and the 30-year bond, we're seeing the hint that these had been solidly in short mode for some time, and over the last few weeks we're seeing hints that they want to go long. In fact, on the daily it is long. So we're going to stay with that thesis. If the bonds rise, that means interest rates are actually going down. So we don't have a steepening yield curve, we have a flattening yield curve. And that would also coincide with a pullback in the market and a pause. Gold continues to have some volatility, but on a daily basis it's still long. Would also coincide with a pullback in the market. Same thing with silver and oil, long. And then we are seeing in all of the many of the commodities, the food groups, we're seeing considerable moves up. So coffees, up 50, 60, 70%. So this is contributing to some of this world inflation and could be contributing to the unrest around the world. Now, as far as Putin goes and the Ukraine, our philosophy is this, that these markets are not moved by retail traders. They're moved by large institutions central banks, large players that are in a position to know what they need to know. They have the teams, and also the political connections. So we try to follow them. And one thing I can say is I don't know what the reaction will be. We saw a strong pop on Friday. That whatever happens in the market, it's not going to get by us. Whether Putin's invasion into Crimea and then into the Ukraine potentially is what triggers this. What we do know is that we're seeing high divergences on overall markets, and there will be a catalyst. Not that there needs to be a catalyst, it's just that the media will put a catalyst to it. These sorts of international events, though, can have can spin out of control. There can be they can be a catalyst, and they can cascade. The next thing you know, we could be talking about someplace else. We could be talking about Iran. We could be talking about China and their islands. So bottom line is get to a mechanical system so that you can follow the objectively and unemotionally the flow of money, so that you can respond and that you too can have a trade manager that looks like this and be trading multiple time frames. Good luck to everybody, and subscribers, we'll have your full video posted tonight by 7. Good luck.